Hi, this is Professor Minton. How's everyone doing? And if you answered that, by the way, you know I can't hear you, right? Anyway, um, so here we are, and I'm in my office in Monticello, Florida, and enjoying the kind of overcast weather today. I may, a little bit later on, I may just walk you around the neighborhood and give you an idea of what my neighborhood looks like, and so you can get an idea of how I spend my time, um, and maybe try a few other things that you might not expect from an accounting class, but maybe just some things to I don't know, give some sense of normalcy, if nothing else. All right, so today what we're going to talk about is Chapter 10, the plan assets. And plan assets, of course, have to be tangible. That means there's something that you can touch. Intangible assets would be things like goodwill, trademarks, copyrights, things like that. In order for us to consider them in the accounting side, they have to actively be used in operations. And I think I may have mentioned to you that I heard something not too terribly long ago where someone said, if you have assets, you should try to use them every day. And that makes a lot of sense to me. Assets that aren't used regularly are probably assets that you don't need, and you might be able to spend your money in areas better served by your resources. Um, so they're also expected to benefit future periods, and that's why we have depreciation on them and depletion on these assets because we expect them to give us future yields. And remember, the purpose again of assets is to eventually convert them to an expense, which then will eventually be converted to revenues, new revenue streams. And in terms of classification, we call those property, plant, and equipment assets. Okay, so now since you don't see my face, I guess the question is, if my face is not here, is there really any person behind this? I don't know. Maybe that's a philosophical question. Anyway, plant assets have essentially four issues, and if you look at the screen, what you're seeing is the purchase of a new car and then ultimately on the downward slope of its useful life until it is disposed of. And when we sell it, in case you're interested in what I mean by disposal, I suppose we could also mean that you took it to the junkyard and got rid of it. But typically, what we do is we depreciate these assets over their useful lives, and then we actually trade them in for a new asset. That's typically what we do. So we have these four things to consider. The first is the acquisition of the asset, and we have to compute the cost. And so we'll talk about all the things that go into the cost of an asset acquisition. Then we have to decide how we're going to allocate the cost over the number of periods that is going to be in use. And thirdly, then we have to account for those subsequent expenditures. And finally, we have to record the disposal when we either sell it or trade it in. Okay, so the first step is to determine what the cost of that asset is, and we would think, well, what did you purchase it for? Well, so I purchased a $150,000 stamping machine. A stamping machine, for those of you who've never seen a manufacturing operation, we have metal that goes into a machine. It can be either operated manually or automatically, and so that metal goes into a over a die, and then you have a stamping component that comes down and goes ka-chunk and stamps out that piece of metal. And then it moves on down the line. Either it's taken out of the machine automatically, or somebody manually removes it and then puts another piece of metal in there, and you have ka-chunk goes on again, and we create another part. Now, in that process, if you think about it, that there's an incredible amount of force that's being exerted on those pieces of metal in order to bend them to that state in most cases. And so, if you think about the floor underneath that stamping machine, a normal floor probably isn't adequate to support it. So maybe you have to build up the floor from, say, 4 inches of concrete to 6 inches of concrete. And so there's an additional cost, and that cost gets added into the cost of the asset. So say it's $1,000. So that would be if you had a $150,000 asset to start with. Now you got a $151,000 asset, and then you may have some taxes associated with it. You may have some training costs because you don't know how to work the machine. So the factory sends down a trainer to work with you for a week to make sure that you understand the correct functioning of the machine. And if that training cost is passed on to you, then it becomes part of the cost determination for the asset. Same thing would be true for any shipping costs and other costs that are associated with that asset. Now, we have to make a we have to make a distinction between the normal costs of that asset and then some costs that we might incur because someone makes a mistake. All right, so we have the machine um, on the way to us, and it's on the truck, and we've already built up the floor. The concrete is cured and everything, and now we get ready to unload the machine, and we drop the machine on the concrete floor, and it breaks the concrete because of the force that got added, and maybe it messes up the machine a little bit. And so we have to have the factory come down and look at the machine to make sure that it's still in running in specification. Um, and we also have to repair the floor. Now, those would be costs that would not be part of the normal cost of the asset. Those are simply repair and maintenance type items. So you have to understand that we're talking about the acquisition cost and reasonable expenditures necessary to get it into place. So if we drop the machine, that's not a reasonable expenditure. That's a careless act. And we couldn't count that as part of the cost determination. It would be simply a repair. So on that next slide, you would have seen some of those costs that I spoke of. And here, let's talk about buildings for a second, because buildings are a little bit different animal. And with buildings, you have title fees, you have brokerage fees, attorney fees, and of course taxes as well that you have to consider. Now, earlier on this semester, we talked a little bit about land improvements, and this is probably a good time to reinforce that discussion. And land improvements are things like parking lots, walks, lighting systems. So if you think about our campus, we have lots of lighting systems around the campus to light up our parking lots and our walkways and our buildings and so forth for safety reasons, among other things. But those are not part of land. Those are considered to be land improvements. You know, your driveways, your parking lots wear out and over time. So we have to treat those differently. We're going to depreciate those over the useful life of the improvement. We never depreciate land itself. And it's worth a few moments to talk about land because land has, in and of itself, it has some different things that you have to consider. And I'll just point to some of those. You have a title search. So you have things like quitclaim deeds and things like that where you have to go out and make sure that you have clear title to the land. You have transfer fees, you have surveying fees that might be incurred, and title insurance premiums. And all those are a little bit different. And again, remember that land is not depreciable. But all of these additional costs here will go into the cost of the land. Now, this looks like a very good accounting examination question. And we are going to refer to it as a lump sum purchase. So we have, and we'll just read through it here. CarMax paid $90,000 cash to acquire a group of items consisting of land appraised at 40,000, a building appraised at 60,000. So now you have 90,000 to allocate over $100,000 worth of appraised value. So what we have to do is we have to work it through a formula. And in this case, we have the building appraised at 60, the land at 40. So that's a 60-40% split. So we have $90,000 now that we'll have to a portion that way. So 60% of 90 is 54,000, and 40% of 90,000 is 36,000. So what we'll have here is $36,000 of the purchase that will not be depreciable, and 54,000 that will be. Okay, so in this class, we're going to look at three different means of computing depreciation. And there'll be the straight line, which is the easiest method, units of production, which is only marginally more difficult, and the declining balance methods, which generally are the ones that give students the most difficulty. Well, so I'm sure you've heard the term depreciation before, and we usually use it in terms of a automobile. So you go down and you buy an automobile for $40,000, and the common thing is we drive it off the lot. You come back and you say, "Well, I don't like it," and so you ask the dealer to buy it back, and he says, "Okay, I'll buy it back for 36,000 because it's no longer new." Well, that's a little bit of an exaggeration in this case, but if you put any real mileage on the vehicle at all, where they couldn't sell it as new, then it would be no longer a new vehicle. Now, with the depreciation that they would take on it from the pricing perspective, would it be excessive? Well, probably so. But you know, a new car is a new car. It's one that doesn't have any appreciable mileage on it, and in the case that we're talking about, there would be some. Now, you have this acquisition cost. Okay, remember that we built up that cost on some of the previous slides, and now we have to figure out how we allocate that cost over the lifetime of use that we're going to get out of that particular piece of equipment or a vehicle or whatever the asset is. And as we do that, we're going to put it on the income statement on the one hand. That is, it's going to reduce income. And remember, by the way, that from a cash perspective, that this is a non-cash expense because the other side of it isn't cash. We've already expended the cash when we bought the asset. In this case, what we have is a contra asset or accumulated depreciation that we're going to put on the other side. There's some very good reasons for that, by the way, and we'll talk about those as we go forward. Okay, so what are some of the factors that have to be used in computing depreciation? There are three. We have to look at the cost that we built up. We have to determine a salvage value, and the salvage value could be done semi-scientifically, probably. We would look at other assets of that type, maybe look at a Kelley Blue Book to see what assets, vehicles, for instance, might be worth of that particular type 5 years from now, if that's the useful life that we choose for the vehicles. And we're probably going to keep the same useful life for all of our vehicles. So if we have a car, we might use, say, 3 years or 5 years of useful life. And if we bought a truck, we would probably say, well, that has 5 years of useful life as well. So now we're going to look at these three depreciation methods, and they have given us some information. The first is the cost, in this case, 10,000, a salvage value of 1,000, and depreciable cost of 9,000. And I'll stop right there and just tell you that we never depreciate below the depreciable cost. So whatever that salvage value is, we're going to leave it at that, and we're not going to depreciate. In this case, we're not going to depreciate this asset beyond $9,000. In this case, the useful life we've determined to be 5 years. And we have another thing down here called units inspected, and they're giving you that because that's the basis upon which they're going to do units of production in a few moments. Okay, and as I said before, straight line is the easiest one to compute because every year it's the same amount. Now, where it can get a little bit sticky is when we buy this asset at sometime during the year and we are picking it up on the basis of how many months we own it. So we could have a portion of a year, to depreciate. And I should kind of also stop at this moment and talk about conventions that some companies use. Some companies say that if they buy the asset in the first 6 months of the year, they take an entire year's depreciation. Okay. If they buy it in the second 6 months of the year, they take a half year depreciation. That just makes the computation of these things easier than looking at them in terms of the number of months. Most accounting books and problems are going to use just the months. So if you buy it in September, if you buy it on September the 1st, for example, you'd have 4 months on a calendar year basis of depreciation to take. Okay, so the cost minus the salvage value, in this case, 10,000 minus 1,000 gives you 9,000 divided by the useful life in periods. In this case, we're looking at 5 years, so we have $1,800 a year. And again, if you were taking a partial year, let's just say that you were, in the example that I used, you bought this asset September the 1st, then you would be looking at only 4 out of 12 months, or a third. And so a third of 1,800 is 600, and you would have, and for your entry there, depreciation expense 600 and accumulated depreciation machinery 600. In this case, we're looking at the entire year and saying that we have the whole year to depreciate this asset. So now let's take a look at the balance sheet and see what the balance sheet would look like. And there at the top, you can see how this depreciation expense works under straight line. So over a 5-year period, you're going to depreciate this at $1,800 per year. But notice on the other side there, on the right-hand side, where they're looking at the year-end book value, which will continue to diminish until it gets down to $1,000. It'll never go below that as long as we have the asset and the asset's not impaired. Well, there's some other things that we might have to consider, but generally speaking, it would sit on the books until we dispose of it at $1,000 once you have depreciated the 5 years worth. So in the instance that they're showing you, that's a 2-year depreciation. So the accumulated depreciation would be 1,800 times 2, or 3,600, leaving you with a book value of 6,400. And this slide, of course, is the representation of that over the entire 5-year period. And notice that the depreciation rate here is 20%. I just want to point that out to you because 1 over 5 is 20%. Okay, the units of production method is a little bit more complex, not that much, but it's a little more complex. And the first step is to determine the depreciation per unit. And if you'll remember, that they gave you 36,000 total units of production. So your cost is 10,000, your salvage was 1,000, leaving you with 9,000 over 36,000, which is the total units of production that they gave you as well. So once you've got that number, then you're going to take that to get your depreciation expense. You'll take that value that you arrived at in step 1 and multiply it times the number of units that were produced during that period. And so this is the actual screen showing you how that's done. So we have 25 cents a unit when you make that calculation of 9,000 divided by 36,000, and then they tell you that assume that 7,000 units were inspected. So now you're going to take 25 cents times 7,000 and arrive at $1,750, which would be your depreciation expense for that period. Now, if you had, so for example, now if you had 35,000 units that you produced, and let's say you went crazy here and you had production for whatever reason, that exceeded what your estimate was, then you'd still take the 35,000 units times the 25 cents a unit to get to your depreciation, but then you would only have another 1,000 units left to depreciate. And so what they're giving you in this slide is a more reasonable depreciation schedule, and you need to look down at the number of units that they're producing. So in 2019 it was 7, In 2022, it was 7. In 23, it was 5,000, and so forth. And each year, you're just going to multiply that number of units that you produce times the depreciation per unit, um, and you'll get to eventually you'll get down to where you have $9,000 of depreciation. In terms of the entry, every year it'll be depreciation expense debit for whatever it is. In this case, 1750 for the first year, and accumulated depreciation machinery for the credit side. So now here's where it gets more interesting. So you started out with $10,000. You took 40% of that, or $4,000, and now you're going to subtract that 4,000 from the 10,000, which leaves you 6,000. Now you're going to take 40% of the 6,000 in year two, which gives you 2,400. So now you have accumulated depreciation of 4,000 for the first year, 2,400 for the second year, and leaving you now, when you subtract 6,400 from 10,000, with 3,600. And you'll take the 3,600 times 40% and get to the depreciation expense for the next year. You'll do the same thing. You'll accumulate it over here, subtract it from 10,000. Now you're left with a balance of 2,160, which you take times 40%. And that gives you $864. And now you're going to do the same thing again, and you're left now with a book value of $1,296. Now remember, we never depreciate below the salvage value. The salvage value is 1,000. So even though when we look at $1,296 times 40%, that's several $100s, we're not going to use that because we can't. We can't go below $1,000, and this is where it gets a little tricky. So if you notice now, it's the final year's depreciation is $296, and you're left with $9,000 for total depreciation expense over the course of the asset, which is actually the accumulated depreciation, and left with then a book value of $1,000. Remember, you cannot depreciate below the salvage value. Okay, so let's take a look at these three different depreciation methods, and you notice that with straight line, it's always the same. It's always $1,800. With units of production, it varies according to the numbers produced. So some years are higher, as in the case of 2021. It's higher than the 1,800, and some years are lower. In the case of 2023, it's only 1,250. Now take a look over here at the double declining balance method, and that's what we call an accelerated method of depreciation. It's designed to get more expense taken in the early parts or the early years of the asset's useful life, and less as we go forward. That's why they call it a declining balance method. And so you notice that in 2023, you have $1,800 worth of expense on straight line, and double declining is only the 296, but you made up for it in the early years of the asset. I will tell you that later on we're going to talk about MACRS, which is the government's decision about how these depreciation methods would be calculated. And the government's method is called the MACRS, or the Modified Accelerated Cost Recovery System. And because government always has to have these cool acronyms. And in this case, what it does is it's just another accelerated method that lets you write off an asset faster. And again, remember that what happens when you create expense for taxes, the more expenses you have, the lower your net income. The lower the net income, the lower the tax burden. So before I get into depreciation for partial years, which I've already dealt with a little bit, and the changes in estimates, I do want to talk to you about kind of the logic behind why we do accelerated depreciation, because it's a lot easier just to do straight line. And we may do straight line for the books just simply because of the ease of it, but I think computers have kind of Taking away some of those arguments, it's just as easy to use MACRS for book purposes and tax purposes. Um, you may want to do book straight line depreciation for books because it smooths out that depreciation expense every month and every year. And smoothing out your income allows you to show a more linear progression through your income. And that's what stockholders like to see is more linear progression, kind of an upward slope, but not a lot of up and downs. That makes investors nervous. So you may continue to use for book purposes, you may continue to use straight line even though you're writing it off faster on your tax return. And if you think about it, that's going to create a timing difference because you have taxes showing one depreciation method, you have your book showing another depreciation method, and accordingly, you're going to have that gives rise to a timing difference that you'll have to work through a little bit later on. Okay, so here's the first screen for partial year depreciation, and we talked about it a little bit. I used the example of September the 1st, which in this case would be 4 months worth of depreciation. They're using the case of October the 1st, which would be 3. And you notice that they look here and they say, well, 3 over 12. But I'll give you a little piece of advice. For most accounting examinations, 12 is a number that is going to give you kind of some funky results in some cases because of rounding errors. It's a whole lot better to treat that as 1 over 4. It makes the numbers come out a lot clearer, and in general, it does. Um, and just easier to work with if you're dividing something by 4 or 3 as opposed to dividing it by 12, especially if you're under a time pressure and computing your examination results. So in this case, what they've done is they simply are going to take 3/12 of it. And so we're going to purchase this piece of equipment October the 1st. And so 3 over 12, or 1 over 4 in this case, will give you $450. Now, here's the trick, or here's the key to that. You have a 5-year asset. In your first year, you're only taking a fourth of a year. So that means in year 6, you're going to be taking 3/4 of the year to get to your full 5 years. And you only use a quarter of the year in your first year. Okay, so if it wasn't clear already, if you're predicting a useful life of a piece of equipment, and if you're predicting a salvage value, then by definition, that makes depreciation an estimate. And so what happens when your estimates are proven incorrect? And that's what this next section is about. So here we'll work through a practical example. So you have that piece of equipment that in the third year, the book value is 6,400. And so that's the $10,000 less the 1,800 times 2, or 3,600 of accumulated depreciation. So your net book value at the beginning of year 3 is 6,400. Now, and it says here, at the time it is determined that the machinery will have a remaining useful life of 4 years. And the estimated salvage value will be revised downward from 1,000 to 400. So what we have to do now is we're going to have to recalculate that based upon these new book value, revised salvage value numbers, I should say, and the useful life that has changed from 3 to 4 years. Because remember, we were starting at 3 years, and you have 5-year assets, so you have 3, 4, and 5. And now we're saying, well, wait a minute, it's going to be actually an additional year or a 6-year asset, not a 5-year asset. But in addition to that, because we're going to have this extra year of use, we're not going to have $1,000 worth of salvage value at the end. We're only going to have 400. So now we're going to take that 6,400 minus 400, give us 6,000 divided by 4 years, or $1,500 each year that we're now going to depreciate in years 3, 4, 5, and 6. Okay, so let's just look briefly at this idea of an asset impairment. And so in this case, we're talking about fixed assets, and fixed assets can decline in value, and the decline could be permanent in value. Um, but in our world today, we more often think about things like goodwill, trademarks, and other intangible assets. And when the auditors come through every year, they're going to look at all those intangible assets. Let's say the name, for instance, Google, or the name Facebook. And with those, we have a value assigned, and we may look at that and say, well, for whatever reason, the value is no longer there at the same level, and it looks like a permanent decline. So we're going to have to write the asset down. In this case, we're talking about a fixed asset, but we're going to do it at pretty much the same way. We would just have a different credit in the case of a, a trademark impairment. In this case, what we have is an impairment loss of $50, and it could be $500 million for that matter, um, and a accumulated depreciation equipment of $50. So think about what's happening here. Normally, what we do is we're going to debit depreciation expense on that asset and credit the accumulated depreciation. And what does accumulated depreciation do? It reduces the book value of the asset. And so we're going to accomplish the same thing here, except we're not going to debit depreciation expense. Instead, we're going to debit this loss called impairment loss. Okay, and this will probably be the last slide. I want to keep this thing down to some manageable level. And so we have two different kinds of expenditures here: capital expenditures, revenue expenditures. And let's just walk down through. A revenue expenditure does not materially increase the plant asset's life. So if I go up and say I have a roof that's leaking, all right, and I go up and I patch the roof, well, that didn't really change the roof asset's value materially. Materially meaning importantly, okay, or significantly. Um, Recorded as an expense during the current period, that's the way that we handle it and report it on the income statement. Capital expenditures are different. They expect to provide benefits for longer than the current period. So if I replace the roof, maybe that adds an additional 20 years of life. And so I have to look at that differently. I'm going to treat that as an asset and report it on the balance sheet. So I'm not going to get too deep on that in your examination, but what I will talk about would be those three depreciation methods in particular. I'll be talking about asset impairments. We'll be talking about partial year depreciations. And so the ones that you really want to pay attention to are units of production, the straight line method, the double declining method, and make sure you know how to calculate each one of those. Make sure that whatever you do, that you do not go below the asset's salvage value. And that concludes this particular lecture.